Hey Simon, global markets have been falling since mid-February, and a lot of pretty famous fund managers are warning that this is a bubble. Is it time to panic?
It is true, there are hallmarks of a stock market bubble building. You have these heightened valuations, frenzied speculation in obscure loss-making stocks, and really quite remarkable market exuberance amidst the worst pandemic in 100 years. But no, I don't think the bubble will burst just yet. Let's be clear, the risks are high and rising, but I will make the difficult judgment call that this can continue a bit longer.
Hang on. You say the risks are rising, yet you don't think the bubble will burst just yet. Why?
The market has been weak lately, of course, because the 10-year US Treasury Yield has been accelerating upwards since the start of the year. Well, actually, it had been rising since August of last year, but that rise accelerated from the start of this year. And that's a problem for the markets because they see this as a sign of coming inflation. That's because historically, there is this link between the 10-year US Treasury yield and inflation. There is also a relationship between inflation and the Federal Reserve's interest rate. So the market sees a rising 10-year US Treasury yield as the smoke that warns of the fire of inflation that will lift US interest rates. And eventually that will be true, but there are lags, delays, and this lag could last years.
But hasn't US inflation risen since March of last year?
Yes, it rebounded 40 basis points off the March low. But look what it did last quarter. Nothing. Flat as a pancake. And US PCE inflation is still way below where it was 12 months ago. The Federal Reserve's policy committee members are expecting a slow crawl by inflation to 2% by the end of 2023. Importantly, the Fed has told us it is prepared to allow core PCE inflation to overshoot 2% for a period of time so as to entrench an average inflation rate of 2%. So it's hardly surprising then that the Federal Reserve's policymakers also reckon it's appropriate to leave interest rates at effectively zero right through to the end of 2023. Now, after that, the Fed says it will then allow for that inflation to overshoot 2%. So it could well be into 2024 before you see the first Fed rate hike. And don't forget, the Fed could just print more money to buy more 10-year government bonds to bring the yield down.
So it's much ado over nothing then.
Well, we are in the midst of a technical correction. It was looking for a trigger. The rise in the 10-year yield was as good an excuse as any. But my sense is that this correction will be shallow. And much like previous corrections since March of last year, it's likely to be limited to a decline of around 10%, 15% possibly. Now, mind you, I have sympathy for those who reckon this is a bubble, but I don't think this is the big one, the big bursting of the bubble. That would likely come as we near 2% inflation. We are not there yet.